everybody. It is the 11th day of October, 2022, and this is a market brief. I missed you last month. I went on vacation and I needed it, and I'm refreshed and ready to go again. I hope everybody is doing okay, and I suspect you're a little concerned about what's going on in pretty much all the markets. And so it's an interesting world right now. I wanted to talk to you a little bit and just say, okay, when you look at the various indexes, which I will show you in just a minute, across the world, there's really not much working. I mean, energy kind of working, but outside of that, there's nothing great happening in our world today. So sometimes it's smart to just be safe. I talk to people every day, and a lot of times, they're saying, well, I'm going to wait for something to come back. One thought that you might have, and it's just a thought for you, is to make investment decisions every day as though you just have cash. Would I buy this today, given the fact that whatever's happening in the world and in the economy and in the markets is going on? And if you look at your investments through that lens, it probably will give you a more rational approach rather than saying, I will wait until something recovers its gains. Because in my opinion, which is purely an opinion, we're probably sliding into a pretty good recession. That doesn't mean that there's really anything horrifically wrong. It just means that in the case of the Federal Reserve Bank, we're probably seeing them raise rates to put the brakes on a very expansive economy that has had a lot of cash infusion, an expansive economy from low interest rates that have been making it very attractive for people to borrow money. And they're just trying to pull the reins in a little bit before inflation gets way out of hand. And I'll show you some things that you might say are good. They're good long term. For you and me today, it hurts a little bit. So short-term pain and hopefully some long-term gain, and I'll kind of talk you through some of that. Okay, so let's take a look, first of all, at, I do charts. I like charts, so I do them. And let's look at some stock market indexes. Now, when I look at this, what I'm talking about is an index that has, for example, the S&P 500 has over 500 of the best companies in the United States of America. I would venture to say all of these companies will be around in 2 years, 3 years. They're great companies. When you look at some of the names in that list, it's just like, these are monsters of the world. I mean, these aren't just little companies. I mean, you're looking at Google and Exxon and Verizon and American Airlines and Bank of America. And sometimes these guys have some stumbles, but they're so big, so strong, they can work themselves through any of the problems. And it's not their first rodeo. So don't think that these companies aren't going to do pretty good, because I think they are. So let's look at this, and let me give you what you should be looking at. When something turns green on my chart, that means that day, because this is every day for the past 1 year, that investment that we're looking at went up. If it turns red, that means that investment went down that day. So you can see the daily price of whatever it is we're looking at. So when you look at the first of the year, which was right here, and you say, wow, it was higher than it is today. Let's look 2 years and say it was a lot higher. If you look at it that way, kaboom, the market before us 2 years ago was very expansive and went up. From this point right here, the market is not so expansive and has gone down. So how much? Everybody has to know. Oh, we're down, give or take a few dollars, down 25%. So if you had $100,000, you're down 25,000 if you stayed in this investment. $1 million, $250,000. That's the impact of a market decline. It doesn't mean crash, burn, something wrong. It just means, guess what? This thing's going down. And if you let your eyes look at it, it's been a fairly orderly process. So when I say that, it hasn't been straight down. It's lower highs, lower highs. And so as this market starts to creep down, it's giving you some opportunities to make a better decision, I guess is the way to think about it. How about the bond market? We look at the bond market and see that normally as a safe haven. Well, there's an interesting thing that has occurred here. The bond market in my career has pretty much always been up. Let me give this as much as I can give it. So I'll do maximum on this. This takes us back to 2004, which is where this particular ETF that gives us the US bond aggregate is at. So from 2004, that was actually 9/30/2003, you can see the bond market with few exceptions. There was a crash, 2008. There was something weird. Well, guess what that was? That was COVID. Looked very similar to this one. People sell everything in a panic. But most of the time, the bond market's been fairly orderly and up, and then we get this. So I guess my explanation for you is what has happened is for the first time really in ever, as far as you and I are concerned, not history, but you and I are concerned, the interest rates are being increased and it's continuing to be increased. So the price, which is what you're looking at here, of the bond market is going down. And you say, how come? Is there something wrong with the bonds? There's not. What's wrong is all of these bonds that have been repriced, over time, old ones have matured, new ones have been put in place because they have to keep this index intact. And so most of these bonds today have low interest rates in them. So what's happened is, as the interest rates have been increased by the Fed, this thing right here has gone down in price because the bonds in there might only have a 1% or less interest payment on them, coupon, and that's what's happening. Now I have a visual, and we can take a look at this. I just got this off the internet. So what it says is, as interest rates fall, because the bonds that are issued, if you know this, you're rolling your eyes. If you don't, bonds that are issued typically don't have a floating rate. They have a rate, sort of like a CD. We'll pay you this. They're not going to increase the rates. So if you wanted to, for example, sell a bond in a rising interest rate environment, you would have to drop the price so that what was being paid gave somebody else the same yield that they could get by buying a brand new one, I guess is the way to think about it. So as interest rates go down, the price goes up. As bond prices rise and bond prices fall, you can see what happens. Rates go up, prices go down. Rates go down, prices go up. That's what you're seeing here. So, interest rates and bond prices move in an inverse relationship, I guess is the way to think about it. That was probably poorly said, but it's the best I can do this morning. All right. So as we look at the bond aggregate, just understand that eventually Jay Powell will stop raising rates. That will probably be a great time to start looking at bonds if you're using something like this ETF here, or bonds if you're looking at a mutual fund like PIMCO or any of those other ones. All of them own bonds, and when the interest rates stop being increased, at that point, the prices and the yield will probably be optimal for you. But today, until he stops, you'll probably see these things drop down, just the way it works. Across the pond, Europe, Australia, the Far East, and let me try to bring this back into perspective. We're looking back to 2012. So boom, 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 boom. We're pretty much nowhere in Europe, Australia, Japan, Canada. That's an index that we're looking at. This is a look back to 2012. So we're back a long time. And understand that what we're trying to do here is give you some perspective. When we look at the emerging markets index, The primary players there are Russia, India, China. Okay. If you look back in the Wayback Machine and say right there was the first month, October 2012, here we are 10 years later, hadn't made diddly. Now we've had expansions and declines, but if you were a buy and hold person, you're kind of going, I really hadn't made any money that I've been able to keep. So those are the different indices that we're looking at. Now let's go back to a short chart. Now I'm looking back over 1 year instead of a long time ago now. So as we look at the daily price of emerging markets, you can see this has been lower highs all the way through it, yada, yada, yada. We're not making any money there. So the question is, why would we be in that? It's hard to have an answer for that other than you shouldn't probably. Gold. Everybody's saying, should I buy gold? I hear the commercials all the time. I'm fascinated why people feel like this is going to save you. Doesn't pay a yield, yellow piece of metal. Buy the mine maybe, but don't buy the gold. I mean, it's just, if we have a crash, maybe you can use that as an alternative currency play. I hope that doesn't insult anybody, but it's just not an asset that really is going to save you, I guess is the way to say it. A lot of people use it as a hedge to inflation, but in reality, it goes up and down similar to all the other different stock markets and so on and so forth. Now I didn't do one of these last month, so I'm going to kind of go a little longer. Here's some things. Now, if you're buying real estate, if you're trying to buy, here's an interesting thing. If you look back over the last 12 months, right here was the peak, and that was, right around the first of the year, go figure. And prices of real estate, at least using this index, have been moving in a downward pattern. So if you own it and want to sell it, you might go, the value of the real estate I own is going down. But if you're looking at being a buyer, somebody told me, and it makes sense, higher prices cure higher prices, meaning that when the cost of things gets to where people won't pay the price anymore, the price eventually will have to go down. So there we are on that. If we look at the stuff we build a house with, wood, for example, the price of wood is finally starting to drop. I remember back the first of the year, I had to have plywood and things for a project that we were doing. And so I went to buy it, and it was over $51 a sheet of plywood, and I was in sticker shock. Well, the price has come down some. We're still not in normal ranges, but we're getting closer as our supply chain starts to pick up the pace. The people that cut wood are cutting wood, and things are picking up a little bit. Oil. Now, this is not a direct price of oil. This is me showing you where the price of oil is going. But if you look at Barclays Oil ETN, you can see that oil sort of spiked in June. That was June. And since then, oil has leveled out a little bit. Now, going back in the Wayback Machine and looking back 5 years, oil is still pretty high. Okay? Oil is still pretty high. I'm back 5 years ago. Bing, 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 bing. That was during the COVID, 2019 and so on. The prices were lower. Now the prices are higher. I mean, a lot has happened. I'm not talking politics because I don't do that, but you can look at it and say oil prices are higher, and that's a reality of life. So, what do you do about it? Not much unless you buy an electric car. So there you go. Looking through the world and trying to say, where would I put my money? I think, this is me talking personally, that you should shorten up your maturities on your bond. So let me go back to my bond aggregate here, and then use something that if you wanted to buy this, you could. It's not a recommendation. It's me showing you an example. That little blue line that I just put on the page right there, this one, that is a very short-term treasury ETF that you can buy. Now, think about it. I own an asset, and it's going to mature in 3 months, 6 months, 9 months, 12 months. So the volatility on that is going to be minimal. Why? Because it's going to come due really fast. And then when the new one is purchased to replace the old one inside of this index or inside of this investment, if rates are higher, you get a little higher rate. So it turns over pretty quick. what's happening right now is if you look at the bond yields and you go way out to say a 20-year bond, just for example, and you're saying maybe I buy that because it'll give me the highest yield because I have to be in it a long time. That's not right. You hear the term inverted yield curve, and that means that the shorter maturities actually have either close to or maybe even higher rates, short-term maturities do, than buying something that matures way out on the spectrum. Well, that's what happens when they raise rates. Until that levelizes and the longer term bonds are issued with higher rates and so on and so forth, you're going to see that happen. So sort of doing a layup, as if you're a golfer, shoot a shot that you can come from. This gives you a place to recover from that has low volatility. I mean, crazy low volatility. If we compare this out over 5 years to the bond ag, this thing's pretty much just a straight line. It doesn't waver hardly any, and it pays a little bit of income. And when things settle down, maybe we come back to it and buy the bonds. But this gives you a place to park your money until things go a little better. Now, I'm going to stop for today because I've talked way too long. If you have questions, as always, give us a call here. Give me a call, 336-448-1086. Happy to go through things with you, give you my view on what you might think about 401ks, your regular investment accounts, so on and so forth. And with that, I'll wrap up. Have a great October, and we'll talk to you next month.